What's going on, dude?
What is up? How are you doing?
Good.
What's your
You ready to watch this AFC Championship game?
Yep, who do you got?
Who do I got? Gosh, what is it? The Ravens and the
Ravens and Chiefs?
Chiefs. So you got
Uh, Nin-
Mahomes.
the Niners and Lions.
Okay, this is who I want to win. I want the Chiefs to beat the Ravens, and I want the Lions to beat the Niners. That's what I want to have happen. But I'm not
Right.
100% sure if that's actually what's going to happen.
Yeah, we will see.
I do think it's actually going to be Niners. Um, Niners, Baltimore.
Whoa, what happened there? Uh-oh. Something just happened. Hello, hola, what's up, everybody? Um,
You could probably hear me now.
yeah, there we
That
go.
was my fault. That was, yes, I accidentally clicked a button as I was messing around with my computer. All right. So, hey, let's get into things, man. So, I do know that what I wanted to talk about here today is that there was a lot of things that happened last week, specifically with Tesla. So we had Tesla earnings this last week. There was a lot of noise and a lot of chatter going on about that. And I think that I wanted to cover those earnings specifically just from this last week. And then also look forward to what we were going to like what's going on this next week because it is an action-packed week. We got FOMC, so we got the Fed meeting, and then we also have a couple different earnings, company earnings, and I wanted to cover those briefly because I want to try to get as much as I possibly can in today over the next 30 to 45 minutes, obviously because of the AFC Championship game, and I think that people want to tune into that. But then also just make sure that we can be as concise and as clear as possible. So let's talk briefly about okay, I got to share my screen here. I think we got to do this layout. I'm going to do present, share screen, share screen. Okay, we are going to talk about Tesla. All right. Can you see the screen, Kyle?
I sure can, yep.
All right, sweet. So Tesla's earnings were not good. I think that's probably the best thing to say, the best thing to simplify it as. So Tesla hasn't really grown 3.5% year over year previously. And I think that their EPS also missed. So you can see that right here, that their GAAP EPS missed by 3 cents and the revenue came in uh, below expectations. When you also took a look at I think I got to share this tab. Boom. All right. Now we got the margins and kind of like what the top line numbers look like. So their margins have consistently depressed, and then they're also their production numbers and their delivery numbers have also depressed. So I think that I don't want to beat a dead horse here. So I'm going to make sure that I'm like as clear as like what is really going on here. I think that the most important thing to understand is that, and I might actually pull this up, um, interest rates. Like Tesla is a cyclical business, and they are heavily impacted by interest rates. So when interest rates, like vehicle interest rates specifically, and I'm going to share this tab here real quick. Um, let's go here, and I got to switch this over here with StreamYard. We're going to go like this. There we go.
Yeah.
So you can actually see that it's super important to be able to understand that the entire vehicle market is going through this. So I think I saw a narrative today where somebody was like, yeah, this reminds me of the solar industry and about how you saw margins compressed due to competition. This is what happens in every single market cycle, that new narratives somehow start surfacing dependent on the stock price. And Tesla is down like 25 or 26% year over year. But I mean, the most important thing to know is that with interest rates, that is heavily impacting things like real estate and vehicles because of the overall monthly payment cost. And Elon Musk talks about that all the time, and it makes a lot of sense to me because like when we go and buy cars, we want to get like a monthly payment that is in a certain budgetary constraint. But when you have, and you can see interest rates here, where historically they were hovering around like 3-4%. Then all of a sudden they shot up over the next couple of years, and somehow, coincidentally, that's when Tesla's sales numbers started struggling. So it's like, for me, that's not necessarily too much of a coincidence. That's why it's so important to pay attention to macroeconomic forces, especially interest rates. So as interest rates come down, Tesla's sales will start to accelerate, and then they won't even need to cut prices either, because consumer prices are designed to go up over time. So vehicle prices, especially new vehicles, will consistently go up over time. And then I do think that Tesla's actually going to be able to find their production costs. So during the call that they ended up insinuating, and it's kind of unusual to me that they didn't talk about this at any given point in time, that during that call, one thing that I heard that was very important is that they actually talked about how they are saving every single penny that they possibly could. And then they ended up saying that when they save one penny, they end up saving $1 billion. And Elon Musk was like, yeah, that's kind of funny to think about, isn't it? Like basically insinuating that, hey, we think that we can save a couple percent or save a couple pennies here and there across our production line to help base out their margin profile. And then also their battery business, which has higher margins than the vehicles. And then also when FSD fully rolls out, these are also going to impact the bottom line metrics too. So when it comes down to all the narratives that are saying like they're never going to stop cutting the price of their cars, their margins are never going to stop compressing. This is classic with the stock price being down. I'm very confident that it does have to do with interest rates. And as interest rates continue to fall, Tesla's numbers will improve. Their bottom line metrics will stabilize, and then their sales price for their vehicles is going to stabilize. So like that's really where I stood with Tesla. And then not only that too, but the things that they are working on, I cannot emphasize enough how amazing it is. So like what they're doing with Optimus and what they're doing with full self-driving vehicles is it's very hard to that the market for it to actually wrap around. So like when we talk about FSD, the reason, so full self-driving, what they ended up doing with volume 12 is that they got rid of a bunch of code and then they put it into a neural network, which behaves a lot like a human's mind. So essentially Tesla's FSD, this is now going to be programmed like a human where it can learn and grow over time, like our brains do. And the reason why this is so important is that this isn't necessarily, this is like a step closer to artificial general intelligence. That's the best way to really say it. It's like eventually over time, it's going to be able to learn how to drive like a human can drive with their vehicles, right? So that's essentially what they're, that's, okay, let me tie this all together too, because Optimus is also a very important part of this story too. With the FSD, so like as they continue to improve on their FSD and improve on their neural net, so like think about it like this: FSD, neural net, which is the brain, Optimus, right? And Optimus is the robot, so it's like a humanoid robot. As Tesla FSD improves, Optimus simultaneously improves. So both of these things are part of artificial intelligence. So Tesla is not going to be just a vehicle company. Like right now, a majority of the revenue is vehicles, but they are going to be, like in the next 3 to 5 years, a robotics and AI company, and neural net's going to be at the center of this. And Optimus is going to be one of their key products. And I do think that just from what I've seen over the past couple of years, from the Optimus announcement to now what it is, I mean, we can talk about that at a later time because it really starts to get speculative about the possibilities that Optimus can have. I think that the point that I'm trying to make is that Tesla's thesis is very much so alive and well. And I do think that they're cyclically being affected by higher interest rates, much like how you can see here on the screen, where it's just like when you go from 4% interest rates for vehicles and then double it in just a course of a couple months, really, like your margins are going to be impacted as a vehicle business. So I think that that's what I wanted to talk about with Tesla there. Kyle, what are you thinking about that? I want to make sure that I'm clarifying, like, do you have any initial thoughts there?
No, I don't have anything else, I guess, regarding Tesla. Like I said, I'm also monitoring here. We have some people on my TikTok. I'm streaming on my TikTok for some people who don't know why I keep looking over. I have people just giving their insight. Some people are invested in Tesla as well, so they're excited
Oh, nice.
to hear about it.
Okay, I think I actually have to change my screen here. So let me change because I got to go to a PowerPoint presentation here just real quick. So let's go share screen, and then let's go to PowerPoint. Boom. Okay. Okay, I guess that's not going to work. That's insane. That's okay. I don't need it. So then we'll go back to what the screen that I was at before, and that was going to be on Earnings Whisper.
So something with Tesla as well is the FSD is like a self-learning car, right? Like learns from mistakes and everything.
Tesla's a robot. So
Yeah.
like the cars are robots, meaning that yes, to answer your question simply, yes, like Tesla cars are robots and they're learning how to drive themselves slowly but surely. Like that's what neural net is really all about. Um, and the reason why this is so important is that like you think about robo taxis, like that's going to become more and more obvious over time, like
Right.
especially within the next 2 to 3 years, I'd say. And then in addition to that, like as Tesla gets better, like the Tesla cars get better at driving themselves, Tesla's Optimus product is going to get better as well. Meaning that eventually there's going to be a day where Tesla robots are on manufacturing lines, like the humanoid robots with hands and stuff.
Uh-huh.
And eventually they're going to be in houses. So I could imagine that there's going to be a day that Americans actually have Tesla Optimus robots doing their basic house chores. I could definitely see something like that one day. So let's talk about next week. We got a lot of earnings. It's a huge week next week for earnings. So we got like SoFi, Super Microcomputer. So these are the ones that I'm watching here. And I'm going to briefly touch up on them. And the reason why I wanted to do that is that because we could talk about this slide basically, or not this slide, this part of we could talk about all these earnings all day. And that itself can take 30 to 45 minutes. So SoFi is going to be a bank. I use SoFi, actually. SoFi is going to be coming out. That's a huge retail investor stock. I've talked about this many times, and people can't seem to necessarily understand like why SoFi isn't moving, especially when you're thinking about it like moving to profitability. I think that they're going to do it, but it's being valued as a bank stock. So, and SoFi is a bank. Bank stocks are valued on a price to book ratio, not a PE ratio, which is why you see like JP Morgan with like a 10 forward PE. And the reason why they do this is actually to manage a lot of the risk that is associated with banks. And then Super Microcomputer, I talked about that one last time. If you remember, Kyle, that one was going to be correlated. They did pre-announce the earnings, and it came out incredible. I think that the stock was up like 20 something percent, 30 something percent.
Wow.
UPS, always an important one. I do pay attention to UPS because it gives us a good idea of like what the state of the consumer is, what the overall demand environment is out there from like a logistics perspective. And then we have Microsoft and Alphabet also on Tuesday after the bell. Microsoft and Alphabet, I really pay attention to a lot of their cloud numbers. I mean, Alphabet is going to be a really good indicator into future ad tech stocks too, because it's a huge advertising business. But like Microsoft's Azure and Google Cloud is very, very important, especially when we think a lot about like our cloud businesses earnings. So like Datadog, Cloudflare, Snowflake, things like that. Like these stocks are almost always indexed together. AMD is going to be reporting before NVIDIA. I don't know exactly when NVIDIA reports, but I own AMD. This is going to be a semiconductor company. It's going to give us a bunch of insight into what's going on with data infrastructure and, more importantly, artificial intelligence. Like, is the narrative still alive or is it not still alive? And I'm sure that it is. And then you got Thursday. I didn't really see too much going on Wednesday outside of MasterCard, which is going to give us a better insight into. I mean, I know some people probably follow Qualcomm, but for me, I follow MasterCard to get insight from a macroeconomic perspective on like what is going on with the consumer, like how was their spending habits. American Express recently reported they were up 7% that day, I think on Friday. And then we also got, actually it might have been Thursday. Then Thursday is another huge day where we have four big companies, Apple, Amazon, Meta, and Atlassian. So Atlassian is a cloud stock, but everyone knows Apple, Amazon, and Meta. Apple is going to give us a better insight into like what's going on with the consumer on a macro perspective, because of, everyone needs iPhones, like how are their sales actually going to end up looking? For me, I don't want to say that I'm bearish on Apple. It's hard to be bearish on Apple, but I do think that it's, I don't know. I just don't understand why they're valued at like a 28 forward PE. Like at some point, it really does get kind of confusing. Amazon, we have AWS numbers, which Snowflake specifically is very much so indexed to, as well as Datadog. So those are two stocks that I own, where I always follow the AWS numbers to get a better understanding of like, are we going to come in above expectations or below expectations? Meta, I'm really interested to hear what's actually going on with like their AI data. What is it called? Like their AI data warehouse or something, or like they're building a massive infrastructure. I want to hear more about that. I don't know what Zuckerberg is actually talking about. I'm sure he's going to be talking about that more on the call. And Atlassian is like a collaboration software cloud. This is going to give us a better idea of like what's going to happen with cloud stocks moving forward, for the rest of this earnings season here. Like ServiceNow ended up coming out not too long ago, so that was great. They actually reported, but they usually report good numbers, so I'm not super worried about that. Then what I wanted to do is actually talk a little bit about FOMC this week. I wish that I actually could share my PowerPoint here, and I might actually try to give that a shot here. FOMC, I'm going to try to multitask. Hey, what's going on, Sam? I see Sam there. Yeah, of course, man. I'm happy. I love actually being able to do this for you guys. I know that there's not very many people that actually watch it live. Holy crap, I got something in my eye. Well, welcome to a live stream, right? Oh my gosh. Yeah, I love doing these things for you guys, but holy crap.
Got an eyelash or something?
Yeah, man. All right. I guess I'm going to just have to get rid of this contact. Screw it. All right. I needed to replace them anyway, so I'm going to have to do this with one contact, guys. This is like the Marine Corps mentality. Like we're gonna get through this shit. Anyway, so I want to talk briefly about the FOMC coming up this week, and I'm going to try to see if I can figure out how I can actually share my screen with my PowerPoint here. So with system preferences, man, I'm not going to be able to do that just like right now. Go to system preferences and lock the screen by selecting the lock button in the bottom left. Check Google Chrome. That's lame. Okay, whatever. I'm not going to, that's just too much work right now. I got to keep things rolling. So FOMC is going on this week. And then right now what we can see is the current odds for a rate hike is non-existent, but we're probably going to stay where we're currently at in between 5.25 to 5.5, where we have that 90, like basically 97% odds, 3% odds for a rate cut. Now for March's FOMC meeting is a little bit more hazy, I should probably say, meaning that it's a lot closer to like a 50-50. We don't know if we're actually going to get our first cut. I think the important piece to this puzzle here is that we are transitioning toward rate cuts. What this means from an economic perspective is that depending on if the economy actually can stay relatively stable, if like unemployment can stay below 3% or below 4%, let's just say below 4%, and if the Fed is actually cutting rates based on that, like because inflation is coming down and not necessarily because unemployment is going up, then that's a very bullish thing. I think that I actually ended up pulling up this right here. So I can share my tab on this screen. And this is actually the correlation between the unemployment rate and the CPI. Actually, I probably wanted to do, let me actually add the federal funds right here. This might actually be a little bit better to put the correct context in. This just needs to be the percent, not the percent change from a year ago. Okay. So the green is going to be the federal funds rate. The blue is the unemployment, and the red is going to be the CPI. Historically, what you see is you can see that usually, keep in mind, you can see the green, that the federal funds rate and the unemployment rate, so the unemployment rate goes up, federal funds rate goes down over time. So you can see that correlation right here too, where the unemployment started going up, Fed funds rate came down, CPI came down. This correlation is about 100 years old, so that it's definitely not an unusual thing. And you can actually see that back in the late 2000 timeframe, right before the bubble ended up bursting with the tech bubble, where you can see that the Fed funds rate was actually rising because CPI was rising. Then unemployment started going up, Fed funds rate came down. Same thing happened with 2007, 2008 timeframe, where the Fed raised interest rates, they held them there, and then as soon as unemployment started going up, then the Fed funds rate came down. Same thing ended up happening in 2018, 2019. So if the Fed actually pulls off a landing of some sort, and they can lower the federal funds rate before unemployment actually starts to go up, then that's going to be the quote unquote soft landing. I'm not convinced of that in any way, shape, or form. But that's actually going to bring me into my next part of the conversation here in just a minute, and that's essentially because that's going to get into the history of inflation a little bit, right? But I did want to talk about some other things before I started doing that. Basically, let me just wrap up with the Fed. Is that there's three things that we got to pay attention to with the Federal Reserve meeting. Is that we got to pay attention to the QT and the pace of QT. So we got to pay attention to that. We got to pay attention to the guidance of future rate cuts, and then we also have to get a better understanding of how they're thinking about the labor market and if they're going to try to get ahead of the falling or the rising unemployment that is inevitably going to happen. But I think what I wanted to actually do is Kyle, I wanted you to talk here today a little bit. And this is actually going to give me a chance to actually drink some water and, recover here for a second because I can see out, I can't see out of this eye, but I can see out of this eye and it's kind of messing with everything. So tell me.
There we go.
So for those of you guys who don't know Kyle, he was the best man at my wedding. We've been doing this for a long time, and we've actually been investing for a while together. And I think that what I wanted to do is actually talk a little bit about with you, like as a conversation about like, why do we approach the markets the way that we do? Like from a long-term perspective.
Most importantly is because of risk management, I'd say. So, how it seems like most people who have gotten into the markets, especially at the time period that we did, it was more of the get rich quick scheme.
Yeah.
So I was investing, which I always kind of live by the quote when they say, like, if it was easy, everybody would be doing it. So
yeah,
that's kind of what we were doing, or at least me anyway, where I made a lot of mistakes, took a lot of unnecessary risks, and those were not purposeful. It was more so because I didn't know what I was doing. And one of those included was taking on margin. I took on a lot of margin in the ARC bubble, and and it ended up bursting and collapsing on myself. Which, at the end of the day, I learned a lot from it. I lost money out of it, which is what taught me. But the most important thing I guess that I've learned through that is to look at it from a long-term perspective. Don't try to get that mindset of, oh yeah, this is so easy and I'm gonna be a millionaire by tomorrow. The stock market, on average, when you, as an investor in the S&P 500, averages about 9% year over year growth. It has about 70% of the time the market goes up, 30% of the time it goes down. So in the long run, the long run, as you're looking to be as an investor, is positive, and don't make, I guess, risky decisions just to get the money quick. Because again, as long-term investors, I know Dylan is obviously very smart. It's more finding the right companies at the right valuations, and then holding on to their stocks.
That's actually something that I wanted to talk about here, and I wish that my dang PowerPoint was actually working here, but I think that I can figure this out. And I think so. The reason why it's like I wanted to talk a little bit about like why we do what we do is more so because I pay a lot of attention to the macroeconomic side of things, and there's a reason for that. And it's not because a lot of folks talk about macro, and sometimes I don't exactly know why, because it's not helpful. It's not actionable. It's not like they'll ever talk about. So they'll never directly talk about like what's the trade, right? I think that's the best thing. It's like when something is actually going on in the markets right then and there, like what's the trade? I mean, it's cool that gas prices are going up. Good observation. or it's cool that, China's economy is struggling. Good observation. But what's the trade, right? And that's like the macro thing. So like when we were talking about the ARC bubble, a lot of folks ended up getting into that, and it was a bubble burst, right? And then a lot of folks ended up buying a lot of crappy companies, and they didn't know why companies were even going up, because a lot of people actually end up finding their thesis, or they validate their thesis based on stock price movement. But nothing over the past like 3 years has been further from the truth than following stock price and gaining any sort of conviction from that, because of what ended up happening in both the 2020 pandemic, late 2021's bubble collapse, also 2021's like the stock market peak, which happened in November, which was basically like the end of the bull market, where we ended up going on like a year and a half long bear market, right? Macroeconomics speaking, what happened? Like, that's the most important thing, is like what actually happened, right? And that's one thing that people don't ever talk about, but it is the most important thing, because there was actually a very, very solid lesson to be had there. Number one, stocks got expensive. And that's exactly what I wanted to talk about here. Jam and Ball, 10 out of 10 recommend following this guy. You can actually see what happened during that 2020-2021 market cycle, where revenue multiples got absolutely insane with growth stocks. So historically speaking, like, this was equivalent to the dot-com bubble, where stocks were valued at like 50, 60, 70, 100 times price to sales. Like, I think Sentinel One and Snowflake, they were valued at 100x times the sales. And there was actually Seeking Alpha experts that said that cybersecurity stocks should justifiably be trading at like 45 to 50x for next 12 months price to sales. Like, don't ever. Like, there's a reason why there's always a price to be paid for every single asset, and it is important to pay attention to like what we're paying for, and more importantly, like understanding why stock valuations may be higher during some time frames or lower during others. So like today, right now we're pretty consistent with like that late 2018. Like right now, it may not necessarily be the best time to buy, but it's not going to be anywhere like what ended up happening in 2021. Both of the bubble collapses, because this was like the ARC peak right there. I'm not sure. Kyle, can you see my cursor?
Yep, I can see it.
Okay. Like, that was that first ARC bubble peak. And then this one was like the software stocks NASDAQ peak. What ended up happening was, long story short, we did the COVID-19 pandemic. The Fed came out and printed $120 billion per month, right? And this is best shown with this chart right here. They came out and printed $120 billion per month. And you can see that right here. And they just pumped out all sorts of money. Not only that, and I actually pulled up, I was looking for this chart last time, but the federal government blew a hole in their balance sheet, which basically means that they ended up deficit spending, and you can see that the deficit spending was $3 trillion in 2020 for the next couple of years, and they're still doing it right now. This is like wartime recessionary deficit spending still to this day. Like, in order to be able to actually get inflation under control, you have to control the deficit spending. So Milton Friedman said something very important. And this is kind of like rolling into like what we talked about last time, where I said deflationary forces are going to be the things that crash the stock market, not inflationary. And the reason why is due to like what we're trending towards, and more importantly, like what they're actually doing to control inflation. Because if you see this chart right here, right, deficit spending is becoming more normalized. In the event of a Trump presidency, and I'm not trying to share like my affiliation or anything, but in the event of a Trump presidency, this is likely to still be more normalized to get inflation under control. In addition to this too, the Federal Reserve is still rolling off assets onto their balance sheet, and the federal funds rate is at 5.25 to 5.5%. What this is essentially saying is that we are currently destroying money, through the form of QT, restricting a lot of the money in circulation, or the restricting the flow of new money printing, which is in the form of higher federal funds rate, lower deficit spending. And all those forces at the same time is actually leading us more towards a deflationary event, not an inflationary event. So a lot of the times people on Twitter or X now and YouTube, they talk a lot about like the supply side of inflation. And they're always like, oh man, look at the container rates, like it's going up. And it's like, because like there's been three major inflationary episodes prior to this one in American history. First one was in World War One. So during World War One, the federal government once again deficit spent, which basically means blowing a hole in their balance sheet, increasing the debt that they have. They did that during World War One. There was a major inflationary episode, especially in commodity prices, followed by a depression. It was like quite literally the forgotten depression of 1919, 1920. Followed by World War II's inflationary event. So following World War II, so like in 1945 to 1955, there was also an inflationary event during that period of time, once again directly correlated to the deficit spending, also the baby boomers. So like everyone, they spent a ton of money during World War II, which is the deficit spending I'm talking about. Then that followed 10 years of inflation. Now the inflation spikes were more like, there's two major inflation spikes, but still, nonetheless, yes, you could contribute that moderately to like an influx of workers coming back home, all sorts of money in people's pockets, but still, once again, directly correlated to government spending. Then comes the 1960s to 1970s timeframe. Like what ended up happening there? Once again, too much money started being printed at the exact same time. So that was the guns and butter timeframe, where that was a government policy where that was during the Vietnam War. So during the Vietnam War, the federal government thought that there was a lot of, this is like the first time that they really actually had a little bit more like social policies in the guns and butter type of, that's all I can really say about that, right? There's a lot more social policies. I don't want to get too confrontational or whatever it might end up being, too divisive. But that's essentially what the policies were. And then in addition to that too, they also had the baby boomer generation coming of age. The 1970s timeframe was the most unique part of this because it was both forces in conjunction working together. Money printing is the printing of debt. So Kyle, did you learn about that like with some of the courses that I sent you?
Oh yes. Yeah, what he's talking about is Andy Tanner has some awesome courses. I'm on the fourth module right now. I don't even know how many modules there are, but learning about the federal government, about spending, how the federal government manages money supply to, I guess, well, kind of like what you were saying with what's the trade. So it's like there's what does the federal government do to balance things out? Because I know a lot of people look at the federal government and they're upset at certain things that they're doing or whatnot. But at the end of the day, they're balancing the trade-off of like COVID, for example, inflation, population growth, technology, like whatever it is. And that's the job of the Fed. So there's still a lot that I'm learning in there.
Yeah. So there's two ways that you can create money essentially. And through the form of debt is that you can create money through, number one, federal government spending. So increasing the debt load on the Federal Reserve's balance sheet. That's the first way that you can create money. The second way that you can create money is actually through the fractional reserve banking system. And this one is like why I sent that to you, Kyle, because I'm like, man, if you want to understand macro, you got to start with this course. Because through the fractional reserve banking system, when you understand that your money is not actually your money. So if you have $100,000 sitting in a bank account somewhere, that bank actually keeps 10% of it and then lends out the other 90%. Well, it's not that, which is interesting because like that 10% is the only money that you will actually have access to at any given point in time, which is why bank runs happen. But when when banks actually lend out that money, they create money out of thin air, right? Mm-hmm. So they're actually saying, and they're increasing the asset side of their balance sheet by keeping the liability side the same. This goes into like a lot of accounting, and that's the tough part is being able to see the flow of accounting. So in this particular case, the fractional reserve banking system does create money, which is why the Federal Reserve raises the federal funds rate. It raises the federal funds rate to prevent this from happening. So that's why that's why they know that it controls inflation, because it reduces it slows down the pace of money supply growth on the private side of things. Then on the public side of things, which is the federal government, this is also the other way that you can create inflation. And especially when you got both of those two working at the same time, like you get this crazy money supply dynamic. So like right now, the federal funds rate is at 5.25 to 5.5%. But the reason why CPI has been so high recently is because of that federal deficit spending, because they are still printing money. They are still increasing the money supply growth. And you can actually see that. I pulled up the M2. So you can see that right now, this is starting to moderate. So this is more of the pace of change on a year-over-year basis of M2 growth. But now you can see this is actually becoming a little bit more moderate. Where before, this is right here. So like you can see, March 1st, 2021. This was the money supply from 2020 to 2021. And this is, okay, there's two different types of money supply. I'm not going to get too much into the weeds of this. There's banking money supply, which is what QE does. That's what, so when the Federal Reserve buys back government securities, increases the banking system's money. Then there's real economy money. And that's going to be M2, or measured by M2, which is basically a rough way to be able to measure that. M2 skyrocketed in 2021. And if you actually pull up like World War II and World War I, post-World War I and post-World War II, the other inflationary episodes out there, money supply also grew very rapidly during that time. And then even from like a 1970s perspective, money supply also grew rapidly during that time, which was followed by inflationary events. I mean, my homie, Milton Friedman had a famous quote where he said that inflation is always and everywhere a monetary phenomenon. So Milton Friedman was a world-renowned economist. So you can see that right there. Inflation is and everywhere a monetary phenomenon in the sense that it is and can be produced by a more rapid increase in the quantity of money than an output, right? That is why I do not believe that we are actually going to go into any sort of inflationary event which could create a market crash, right?
Right.
We are, because of quantitative tightening, because of the 5.25 to 5.5 federal funds rate, because of the deficit spending being more moderated, now all of those factors working together is telling me that there's one thing that we have to be aware of, and one thing that we have to be cautious of, and that is a stock market crash based on a deflationary event, or a recession. A recession is a deflationary event. I think that next time we can talk a lot more about that. But like, Kyle, what sort of impact do you, or what sort of feedback do you have, like from what you've learned so far?
Yeah, so kind of like what you were saying, it's almost because I know how the Fed's job is to balance money supply, balance the economy, or stabilize the economy. And there's so many pressures that are pushing towards inflation, pushing towards deflation. And it's like when you see, and I believe this is kind of where Dylan is getting at, there's so much that the Fed is doing to push inflation, which is meaning that at some point they can't do anything else anymore that's going to tip over on the deflationary side, which is why some sort of deflationary event is what is going to end up crashing the market, or at least a huge something.
And then it even makes me more nervous too when you look at those stock market valuations. So like the last deflationary episode that we had during 2008, the forward PE metric dropped down to 10, 11, 12. But today we're at a 20 on the S&P 500. So why is this important? I mean, I don't think that there's anything that's more important than this chart right here, because when you think about like what the potential downside for the markets is during a deflationary event, I mean, there actually absolutely is a chance that we could see a 50% decline on the stock market, which would put us basically a round trip back to COVID lows. And I'm not saying that that's going to happen, because that's a very, very far-fetched thing to think, because of how rare it really is. And it happens like once every 20 years or so. But I am saying that when stock prices get this high, especially in large cap stocks, where right now it seems like all the institutions and funds, they just want to pile into one thing, like one asset, and that asset has to do with AI and Nvidia, right? Because Nvidia just cannot stop running, and analysts are just can't, they're stumbling over themselves to revise all their estimates upwards. I'm not talking crap about Nvidia, but this is a historic, this is like a constant trend with like what funds do. They pile on to the same thing and then they pile out. And they do this time and time and time again. And right now, that pile in is absolutely in large caps, and more importantly, like the Mag 7. I mean, Microsoft's forward PE is like 33. Apple's is a 28 with like 5% growth. I mean, I think that they're going to hit 5% growth this year, but I mean, this list can go on and on and on. Where it's like they pile into the same companies, they leave a whole different sector, a section of the markets, which is the small and mid caps, and you can see that here. Left for dead, and they say, oh, these are bad companies, but it's like, not really. Narrative has it that they're going to be bad companies, but they're actually not that bad of companies. And you can see that right here, this is the best correlation that I can show you guys from like this is the monthly forward PE. From a large cap perspective, this goes to show like how, so like the median is about normal. The median is consistent with like 2015, 2014 levels, 2016 levels. But when you see like this forward PE ratio on the other large cap stocks right now, this is similar to what ended up happening in the tech bubble. My biggest fear, my absolute biggest fear, is that this euphoria of dumping into the same 10 stocks, 6 stocks, 7 stocks continues to happen, that we do end up getting like this AI bubble. And it is going to be the end of the bull market, the secular bull market that stopped in 2009. And I don't want that to happen. I want just I like my corrections. I like, just moderate price appreciation, tempered expectations, no euphoria in the markets, because it's not a fun environment when you're investing in euphoria. You have to become a trader during that time. Like, you have to be aware of what's going on. And also being very, very okay with selling. And I like buying more than I like selling. So I think that's all I really had for today. But Kyle, is there anything that you can fill in the gaps here, stuff that I may have missed?
No, not that you missed, but I guess to add on to kind of what we were discussing earlier when mentioning margin, because that's when, again, back in 2021 during the ARC bubble, when you just mentioned about euphoria right now,
Yeah.
Investing and pumping all this money into certain stocks and taking on margin, taking on unnecessary risk. Or what we were discussing earlier, when I was like, if you want to be like the 1%, you have to think like the 1%. And when you have everybody of the general public all investing and pumping money into stocks, that's a time to be cautious. and
Yes.
and especially to not take on unnecessary risks such as margin, because margin is a great way to lose all your money and to end up going in debt. So I guess that's my 2 cents to add into the euphoria that you just mentioned.
Absolutely. And that's kind of where we're at right now, especially in large cap stocks. But this can be solved by just a simple correction. I think the S&P 500's forward PE is like 20, which is very high. And I don't necessarily know why. So it's either that the markets are seeing something, maybe their next 12-month expectations are too conservative. And if that's the case, then okay. But still, it's when prices get this high, and you can actually see that with Jam and Ball's Substack that I showed earlier, where you can see that even the software valuations are starting to get stretched, which is basically the growth market. It's not like 2021 though, but it's like there is some caution to be advised, especially when it comes down to like AI stocks and this AI euphoria that's going on right now. I do think that being wise and cautious of risk is definitely it's definitely something that we should all keep in the back of our minds until the markets crash again next time. So in the case of a recession or deflationary event, and the markets go back to that 200-week moving average, that's going to be when we want to start buying stocks again. But I think that that's all that I had here. I know that AFC Championship's coming up here in the next 15 minutes, and I know I want to watch it. You got any plans for that, Kyle?
Not really. Probably just put it on my TV here and just chill and relax and watch.
Sweet, man. Well, until next time, yeah, probably see you again here this next Sunday.
All right, sounds good to me.
All right, have a good one, brother.
See ya.